All right, we're going to have some fun with this one, looking at policy loans in action. What is the actual impact when I take a policy loan from my life insurance policy? How does it impact the cash value, the death benefit? Then what's it look like when I repay it? If I only pay the interest, if I don't pay anything at all, and then we're going to look at infinite banking in action as far as mimicking models of paying yourself back extra interest. We're going to break down exactly how that works with policies based on today's dividend interest rate environments so we can see it and attempt to understand it with more clarity, seeing the actual numbers. Let's have some fun here. So what we will begin with is a policy that is designed with the ability to pay in $50,000 per year. So we always talk about policy design. In the past several videos, we touched on that. $5,000 base premium, $50,000 MEC limit. We overinflate that MEC limit a little bit, but the ability to pay in a 1090 split. So why I emphasize that? We did not max this out because when we look at the model with paying ourselves back extra interest, that IBC in action model, we are going to then pay an additional $10,000, a total of $50,000 per year into the policy. We built in extra space. So this is a policy where I have the ability to pay up to $50,000 per year, but I'm going to pay in $40,000 per year. There we go. So the first example, which we always like to look at, is what does my policy look like in terms of cash value and death benefit if I pay money in and just let it sit and grow. Annual internal rate of return represents what I am earning, the net growth year over year. So this model was actually based on a dividend rate of 6.2%. The annual IRR represents the actual growth. So if I look at year 10, the cash value grew that particular year by 4.17%. That was the net tax-free internal rate of return. The 6.2% dividend rate was a gross rate, but then after the company's insurance expenses and mortality charges came out to the 4.17% rate. Now, let's look at that with the actual loan scenario. So in this example, I'm going to look to borrow and then pay back the principal only. So I'm going to principal and interest, but I'm going to borrow and then pay it back in full. So here we take out the $150,000 loan. If this is me, I want to know the impact that that loan has on my policy. Here's exactly how it works. When I take out a policy loan, the gauge that determines how much I can borrow is right here. I pulled out $150,000. My cash value is now $43,000. In the example where I did not touch it, it was $200,000. So what determines how much I can borrow from a life insurance policy is my net cash value. Now, the company tells me that they are going to continue to pay dividends on any money in cash value and this $150,000 loan balance, just like we covered in the last couple of videos. How and why would they do that? So anytime I take a policy loan, again, the cash value is the equity that determines how much I can loan. The death benefit will be collateralized dollar for dollar. So I was at $1.465 million. Subtract that by $150,000 and you will get this exact figure. We pulled this data directly from the illustrations. If you'd like to see the actual illustrations and really digging into it, we do have that in our ILS Agent Academy if you're in the business. So here we go, $150,000 loan. Now we are going to pay that back, loan repayment, at $40,000 per year. Before we look at that actually, let's look at the loan interest here. There we go, 5% interest rate that goes where? Not to ourselves, to the insurance company. So there's that $7,500 interest charge that is interest going to the insurance carrier. Now when we repay it at $40,000 per year, tally up those payments. It is just about $170,000. I borrowed out $150,000, I paid back $170,000. That means the difference, and I'm rounding here, $20,000 went to the insurance carrier. If I stop there, it makes it seem like there's no sense on this because I'm paying interest on my own money. However, when it is repaid, this is a non-direct recognition contract, what do I notice about the cash value and death benefit? When I compare it to the growth example, 100% restored to exactly what it would have been as if I never touched it in the first place. If you look at the annual dividend column on both sheets, what do you notice when the loan's outstanding? They're identical all the way through. And remember that that dividend column does not include the company's guaranteed rate, it is only the surplus. But the moral of the story here is when I borrow and repay, I see everything 100% restored to exactly what it would have been as if I never touched it in the first place. Now, as we progress on, actually, let's look at the no repayment scenario. We're going to touch on these because it's the same thing, but just demonstrating that we don't have to pay it back and what happens if we don't pay it back. So here's our $40,000 per year for 10 years, growth example. This is all identical. Here, exact same thing. There's the $150,000 loan. There's the cash value decrease, the death benefit collateralized, but we never pay it back. So loan interest next year comes due of $75,000 and I choose not to pay it. I'm not paying anything back on this loan because I don't want to, or something came up and I can't. I don't pay it. What specifically happens? Well, the policy is going to borrow from the cash value $7,500 to cover that loan interest. Now my loan balance compounds to $157,500. If I do not pay that loan interest, it will compound. Loan interest accrues at annual simple interest, meaning it is only simple interest over the course of each policy year. And then if I pay the loan interest, it will not compound. We'll look at that in the next model. But here, it just continues to compound. That's why the loan interest increases over time. There's my loan balance. Dividends, however, remain the same all the way through. If I compare those, look at age 60, 11,859. Over here, age 60, 11,859. No difference there at all. Now you do see a difference in the cash value and death benefit over time because that loan balance is certainly creating, call it drag. I mean, look at the difference at age 60, $330,000 in cash versus $590,000. Pay off the loan balance would be fully restored to exactly what it would have been as if I'd never touched it in the first place. So that is the example where I never pay it back. Now in an example like this, I paid in $400,000, I borrowed out $150,000, healthy amount of equity remaining in the policy continues to accrue over time. So I could look at it and say, well, I paid in a net of $250,000 and it's still appreciating, I still have a death benefit, I'm happy with this, depending on how I look at it and crunch the numbers. Let's look at the interest-only example. Identical growth scenario, break even year 5, $150K loan, loan interest due of $7,500, and I pay $7,500 per year. As it's due, I just pay it. And what you'll notice is that cash value is about $150,000 less, $157,500 to be precise, and the death benefit's collateralized by $150,000 all the way through. So if I'm covering that loan interest, I'll see my cash value to continue to grow without any drag on it. So the drag would be loan interest that's still due, but if I'm paying it, I don't have to worry about it in that respect as far as it's slowing down the cash value growth. I'll see very similar internal rates of return as time passes. Now, let's look at the fun one, the IBC one, as far as paying myself back with extra interest. So here is the basic repayment example we started with. Let it sit and grow, borrow and repay, and by year 10, cash value is $468, cash value is $468. This policy was built with additional MEC space. So we have a $5,000 base premium and a $50,000 MEC limit. When we equip a policy, the whole idea of a 1090 split is not to max it out from the beginning. Some people do if they've got the means, but really is how much do I want the ability to add into the policy each year. I might start with a 50-50 or 40-60, and then as my cash flow continues to come in, add more into the policy, we're equipping it with that extra space. Now let's look at the payments in action here. So on the left, $40,000 for 10 years. This is identical. Breaking even, we don't have it highlighted, but it is exactly the same. Year 5 in this example. Now, the same $150,000 loan comes out. $150,000, cash value, $43,000, death benefit, $1.315. Consistent with every single example we've looked at thus far. Now we're going to see a difference. The repayments, we're going to look at the exact same thing we just saw on the repayment model, where we repay it at $40,000 per year. So if we tally up those payments, that's $170K just about, of which $20,000, that's the total interest that went to the insurance company. Now, here's the difference in this model. Extra PUA payment. We are going to pay ourselves back additional interest here. This is mimicking the idea of the concept. To simplify, we're just adding more money into PUAs, which we can do with or without a loan, if the policy can handle it from the minimum premium and MEC testing standpoint. So $10,000 per year paid in while we are repaying that loan. So one thing, just to be completely blunt or transparent here, I'm paying in $40,000, I'm paying back $40,000, and I'm paying in another $10K per year. It's a net of $90,000 out of pocket as far as what this individual is actually doing. But these $10,000 payments here, 100% are directed toward PUAs. We have a 1-year term insurance rider attached to this policy, which means those PUA payments can be made without underwriting, which is very, very important, but you will not see it push up the immediate death benefit. Long term it will, but immediately it will not. So for example, let's look at the repayment stage. Cash value, $523,000. Death benefit, 1.897. On the example to the left, cash value, $468,000. Death benefit, 1.897. Death benefits are the same. Again, that's because we used that 1-year term rider, which if you are new to that, I would check out any of our term rider videos for more details there. But on the cash value, because again, this series is designed to really show people how to maximize cash value. If I'm interested in a whole life policy for cash value, here's the difference. So I paid in $50,000. Do I see an impact of more than $50,000 show up over that 5-year span? Yes. As time passes, what occurs? If I look at age 65, which is year 20 in this example, $841 in cash value, death benefits 1.6 over there, and in the growth model, $745 and about $1.56 million. So you're getting close to $100,000 more in cash value by year 20 by paying in an additional $50 between years 6 and 10. So that idea of treating yourself like a bank and paying yourself back that extra interest instead of an institution is really how the idea of that concept works. Now again, you can pay that $10,000 in PUAs with or without a loan. And I always like to touch on that because sometimes it simplifies it. A lot of people we work with say, okay, well, if I'm going to take loans, I'll borrow and repay them, and then the extra interest, I'll just pay extra money in there anytime. And a lot of them do. But again, I wanted to touch on that. So hope you enjoyed this one. This is always fun, really digging into the numbers. Sometimes it can be confusing. If you have questions, reach out anytime. We'd love to talk to you and work with you if you decide to work with us. Last video we're going to touch on next is on the cash value collateral loans, an actual case study. Going to be a fun demonstration. Hope this one helped. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.